Hey, what's up guys? I am Dison. This topic comes up all the time on my channel, but I've never made a dedicated video explaining why I don't recommend getting a 15-year mortgage when buying real estate. So here we are. I'm going to break down why you might actually be better off choosing a 30-year mortgage, even though at first glance, it looks like you'd be paying a lot more over time compared to a 15-year loan. The truth is, you won't fully understand the benefits of a 30-year mortgage until you really dive into the details. And I'll go over all of that right after you smash that like button. Seriously, this video took me about 3 times longer to plan than usual because of how in-depth it is. So if you could hit that like button, I'd really appreciate it. So to keep things clean, I'm just going to stick to the facts and lay out my reasoning. By the end of this video, you'll be able to make a more informed decision that could put you in a much stronger financial position. Let's start with the basics. What's the difference between a 15-year and a 30-year mortgage? Starting with the 15-year mortgage, the big advantage here is that you get a slightly lower interest rate. For example, according to Chase Bank's current mortgage rates, a 30-year mortgage might be around 5%, while a 15-year mortgage is closer to 4.375%. That lower rate means you'll pay less interest over the life of the loan. Another benefit, you'll own your home outright in 15 years instead of 30, plus you build equity much faster with the 15-year option. But here's the downside, your monthly payments will be significantly higher. If this is a rental property, that means less monthly cash flow. It also means you're tying up more of your money in the home, leaving you with less flexibility. And because the payments are higher, lenders will qualify you for less real estate, which could limit your buying power. Now let's look at the 30-year mortgage. The most obvious benefit is lower monthly payments. Since you're spreading the loan over 30 years, your monthly cost is lower, which leaves you with more money to invest elsewhere, possibly in assets with higher returns than your mortgage interest rate. And when it comes to real estate investing, lower monthly payments mean you can qualify for more properties, increasing your earning potential. But of course, it's not all upside. The downsides, you'll pay a slightly higher interest rate, 5% instead of 4.375%, for example. That also means you'll build equity more slowly and it'll take longer to fully own your home. But here's a secret, that might actually be a good thing. Let me explain with a real-world example. Say you take out a $300,000 loan, 15-year mortgage at 4.375%, monthly payment $2,372. Over 15 years, you'll pay around $127,000 in total interest. Early on, about half your payment goes to interest and the other half to principal. As time goes on, you pay less interest because you're paying off the principal faster. 30-year mortgage at 5%. Monthly payment, wild sans $10, that's $762 less per month than the 15-year option. In the first year, around $14,900 goes to interest and just $4,400 to principal. Total interest over 30 years, $279,000, which sounds like a lot more, and it is on paper. Now here's where it gets interesting. That number isn't adjusted for inflation. Over time, inflation reduces the value of money. With a 2% average annual inflation rate, the money you're using to make payments in the future is worth less than it is today. So even though the total interest paid seems higher, the real cost is actually lower when you factor in inflation. Think of it like this. If I let you borrow $1 today and ask for that $1 back in 30 years with inflation, you're really only paying back around 54 cents in today's money. This is where the 30-year mortgage starts to shine. Even though you're technically paying more interest, you benefit from inflation, and the money you save every month can be invested. Let's look at 2 scenarios. Scenario 1, 15-year mortgage. You pay off your $300,000 mortgage in 15 years. After that, you invest the $2,272 monthly payment in the stock market at a 7% return. After 30 years, house is paid off and you've got about $732,000 invested. Scenario 2, 30-year mortgage. You invest the $762 monthly savings right from the start, also earning 7%. After 30 years, house is paid off and you've got around $941,000 invested. That's a $200,000 difference in favor of the 30-year mortgage. And don't forget, with the lower payments of the 30-year mortgage, you also qualify for more real estate. That extra $762 per month means you could qualify for roughly $140,000 more in mortgage value. So instead of being limited to a $300,000 property with a 15-year loan, you could buy a $440,000 property with a 30-year loan, significantly increasing your earning potential. So what's the takeaway? First, there's nothing stopping you from paying off a 30-year mortgage early. You can treat it like a 15-year loan if you want, just make extra principal payments. But the benefit is that you're not obligated to. It gives you flexibility. If life throws you a curveball, job loss, reduced income, emergency expenses, you can fall back on the lower required payment of a 30-year loan. With a 15-year loan, you're stuck with that higher monthly obligation no matter what. Also, having money tied up in your home as equity doesn't earn you anything. To access it, you'd need to refinance or sell the property, which defeats the purpose of building equity quickly. A 30-year loan allows you to keep more cash on hand, giving you flexibility to invest or spend however you see fit. In fact, once you account for inflation and tax deductions, the real difference in cost between a 15 and 30-year mortgage is pretty minimal. So, why not take the 30-year loan, maintain more cash flow, and, if you're disciplined, potentially end up with $200,000 more in investments? Final thoughts. For the Dave Ramsey fans out there who believe the shortest path to wealth is no debt, I totally get that. If peace of mind matters more to you than maximizing every dollar, then a 15-year mortgage might be the way to go. But here's my suggestion. If you're buying a home for yourself, get a 30-year mortgage, but only buy something you could afford as if it were a 15-year mortgage. That way you keep your flexibility while staying financially conservative. And if you're buying investment property, always go with the longest term loan possible. Cash flow is king and the mortgage interest is tax deductible. Just one caveat. All of this only works if you're disciplined. If you take the savings from a 30-year mortgage and blow it on stuff like boats and nonsense, then yeah, a 15-year mortgage will force you to build wealth by default. So know yourself, play to your strengths, and use this info to make the best decision for your situation. Thanks so much for watching. Don't forget to like, subscribe, and hit that notification bell so you don't miss future videos. Also, feel free to add me on Instagram and Snapchat, and check out the private Facebook group linked below. We just hit 10,000 members and are on our way to 20,000. See you in the next video, friends.